U.S. President Donald Trump says he might skip the upcoming G20 leaders summit in South Africa that is set to take place in November. That's as he disapproves of local policies. Trump has been vocal in speaking out against SA's approach to land, and he's also taken issue with the country's Gaza genocide case against Israel. Well, these tensions are complicating a trade deal between the two countries. That's according to Zane Dango, Director General at the Department of International Relations and Cooperation. Speaking at a seminar in Johannesburg, Dango stated that it's a concern that the U.S. is trying to curtail sovereignty on certain issues to get a trade deal across the line. He couldn't elaborate due to a non-disclosure agreement. This comes as the U.S. intends to implement a 30% blanket tariff on South African exports to the U.S. from Friday, a move that will cripple several industries. South Africa is in the process of negotiating a deal to head this off, but time is running out. Nevertheless, Trade, Industry and Competition Minister Park Stow is confident that a reset of relations with Washington in the next 2 days is inevitable. Parliament has finalised the Eskom Debt Relief Amendment Bill. The move lays the legal foundation for a revised support plan for the struggling power utility. National Assembly passed the bill last week and the National Council of Provinces has now followed suit. The new plan replaces the earlier proposal of a 70 billion rand debt takeover in 2025-26 with a two-part loan package totaling just over 90 billion rand. The amendment also updates the original 2023 Eskom Debt Relief Act and now introduces interest-bearing loans and repeals a key provision that had tied disbursements to strict compliance conditions. That removal has sparked criticism from several opposition parties. Treasury, meanwhile, says the changes reflect Eskom's improved financial position. The bill now awaits the president's sign-off. NUMSA has clinched an above-inflation pay deal with employers in the glass sector. The 2-year wage agreement will see employees receive a 5.5% increase in 2025 and 6% the year after. The pay deal will see the minimum wage per month increase from 8,700 rand to 9,300 rand in 2026. AECI has posted a profit bump. The diversified chemical solutions company has more than doubled its headline earnings per share during its first half. It's attributed the jump to the growth of its international operations and the continued resilience of its core business. An interim dividend of 100 cents per share has been declared. Looking ahead to the second half, AECI says strategy execution remains a central focus as the group prepares for growth, drives hard cost savings, and focuses on free cash flow generation. Glencore has posted a 5% increase in first-half copper equivalent production. This was supported primarily by the contribution of Elk Value Resources steel-making coal volumes. And as a result, the diversified miner is confident it will deliver on its full-year output guidance. The group's production report also noted that a comprehensive review of its industrial asset portfolio was undertaken during the period, and this identified about $1 billion of cost savings opportunities. These are expected to be fully delivered by the end of 2026. More detail will be made available when the company opens its books on the 6th of August. In international news, two German heavyweights, Mercedes and Adidas, have warned of a combined tariff bill exceeding $650 million. This announcement comes as Mercedes downgrades its annual sales forecast and Adidas declines to provide a full-year guidance. Here's more detail.
German giants Mercedes and Adidas flagged hundreds of millions of dollars in US tariff cost. The automaker trimmed its annual sales forecast and profit margin, while the sportswear brand, which missed Q2 sales expectations, held back from increasing annual guidance. That's amid continued uncertainty around US President Donald Trump's levies on European exports. Mercedes reported a nearly $420 million impact in the second quarter from these tariffs, which Trump is preparing to hike for EU-made cars. It now expects an annual profit margin of up to 6% for its car business, down from its forecast of up to 8% at the start of the year. It also sees annual group revenue coming in, quote, significantly below 2024 levels. For Adidas, tariffs will add $231 million to its costs in the second half. It said it held back on annual guidance not only to wait for Trump's final tariff policy, but also to see if levies cause major inflation and impact consumer demand. Despite a stronger than expected Q2 profit, its sales came in lower than analysts' forecasts, sparking fears it's losing momentum after a previous rush to buy its trending Samba and Gazelle shoes. Adidas shares were down more than 7% in afternoon trade.